Hey, I'm Ben from Modern Graham, and today we're going to do a Modern Graham valuation of Archer Daniels Midland Company, so be sure to stick around to hear what I think of this company. So, the company name, of course, is Archer Daniels Midland Company. The ticker is ADM. The current price as of this recording is 84.66. The consumer or the sector is consumer defensive, and the industry is consumer packaged goods. These are the things from the balance sheet that I find most important. We have the total current assets, the total current liabilities, the long-term debt, the total assets, the intangible assets, total liabilities, and the outstanding shares. All of these figures will come into play in this valuation. Over here, we have the chart from the last 30 years showing the earnings per share in blue and the dividends in red. And you can see earnings per share have fluctuated, but dividends have grown almost every year, which is great to see. And earnings per share is at the highest level yet. So that's also very good to see. Looking at the details here, we have the earnings over here, and you can see that has grown, but also the earnings per share MG is the weighted average. So we take the last 5 years of earnings, we put the most weight on the current year and the least weight on 5 years ago to get a weighted average. And that helps smooth out the ups and downs in the business cycle. And for example, you can see in 2011, the earnings went up to 313 and then they dropped in 2012 to 184 before coming back up. But you can see that the drop was not as significant in this weighted average of earnings. Or going farther back, you can see in 2007, the regular earnings went down for a couple years, but the weighted average continued to grow. So that shows the real trend in earnings and can help you in your long-term view of the company. Dividends per share, you can see they have paid a good dividend, and more importantly, they have grown the dividend every year, and they have done that for a very long time. This is a dividend aristocrat. So they've grown their dividend every year for a very consistent amount of time. Dividend yield has hovered between 1% and 3% generally, and the dividend payout ratio has been about 30, 40, maybe 50%. That depends on what their earnings are and what their dividends are, but they have put a priority on growing that dividend every year. The board must really like having that dividend aristocrat trademark, or trademark's not quite the right word, but that quality of their company. Stage 1 is to determine if the company is suitable for the defensive or enterprising investor, remembering that the defensive investor is one who is not willing to go into depth in their research, so they have stringent requirements for any company they will consider. First of all, the market cap has to be over $2 billion. Here it definitely is. The current ratio has to be greater than 2. Here it is only 1.51, so it fails that test. Has to have a positive earnings per share for 10 straight years. It passes that. Has to pay a dividend for 10 years. Well, we know it passes that. And the earnings have to have grown by at least 30% or 33% in the past 10 years using 3-year averages at the beginning and end of that period. Here it has grown by 42%, so it passes that requirement. The PEMG, the price to earnings ratio using that weighted average of earnings, comes to 17.17, which is below the requirement of 20, so it passes that. And the price to book ratio of price is 84.66, value is 43.71, so the price to book ratio is 1.94, which is less than the requirement of 2.5, and so we get a passing score there. And if you've kept count, you have 6 out of 7, so that is suitable for the defensive investor. By default, the company is then also suitable for the enterprising investor who is willing to do further research, and so the requirements are not as stringent. But even if it wasn't by default suitable, it is bypassing all 5 of the enterprising investors' requirements. Now, if you're enjoying this video, be sure to take a moment to like the video. That helps it spread in the YouTube world to more viewers like you who like similar content. Subscribe to the channel to catch more, and of course, download the free valuation calculator found in the comments below. Stage 2 is a determination of intrinsic value. So once you know that the company might be suitable for you, it's time to figure out what it's worth. And the price is not what it's worth. The price is what the market is willing to pay at any given moment. That fluctuates. The value is more steady. It is what the company is actually worth without as much speculation. And to calculate that, we take Benjamin Graham, the father of value investing, we take his formula from his book, The Intelligent Investor, which is value equals earnings per share times 8.5 plus 2 times the growth rate. So we have two variables to calculate here. We have earnings per share, and I use the weighted average here, and the growth rate. So let's calculate those. Again, the earnings per share, modern Graham, is the weighted average the last 5 years. We get a value of $4.93 for earnings per share. Plug that in here, and we take the value or the figure from 5 years ago of $2.87, calculate the total growth between those two of 72.13%. We divide that by 5 to get the average growth of 14%. Then we have a safety margin here because you don't want to overestimate growth. Growth is a key variable in this formula, and overestimating it can make a significant impact. So we have the safety margin, which also kind of takes out of the equation. I know some people like to use a cumulative average growth rate, which the calculation for that is a little bit different from the simple average I've done, but having the safety margin kind of balances that difference out as well. And we get a growth rate estimate of 10.82% for this company. So plugging that into the formula, we have the earnings per share of $4.93, the growth rate of 10.82, and the total value of $148.64, which according to this handy chart here, the current price is $84.66. The value is $148, and that is higher than the current price. So then if we look down in this box, we also see that we are trading at about 57% of the intrinsic value, which is an undervalued rating here as well. A couple other ways of looking at this, we've got a floor here of 1.04 based on the net current asset value, which we'll talk about more in a moment. Then we have the value based on 3% growth of 71.51. And the value based on 0% growth of 41.92. If you put price in place of value in the formula and solve for growth, you find that the market is implying a growth rate of 4.33%. So the market thinks the company will grow at 4.33% every year in perpetuity. If you think it will grow more than that, then you would find this to be undervalued. If you think it will grow less than that, then you would find it to be overvalued. That's another way of looking at this formula and thinking about how you're considering the company's value. Down here, we have the modern Graham grade. This is one way of comparing this company to another company, perhaps in a different industry, by giving it a letter grade. So we look at many different factors that help determine suitability or growth or value and stuff like that. So first, we get 2 points for being suitable for the defensive investor. We get 1 point for being undervalued. We get 1 point for trading below its Graham number, which we'll talk about more in a moment. We get 1 point for having good long-term dividend growth, 0 points for being above a 2% dividend yield, half a point for trading below its industry average PEMG, and 0 for trading below its net current asset value, for a total score of 5.5, which is an A+ grade for this company. Stage 3 is further research. So at this point, if you've determined that the company is suitable for your investor type and you've figured out that you think it is undervalued, the next step would be to do further research to decide if it is suitable for your individual portfolio. And you would have to look at your investing goals and your diversification and stuff like that. Only you can finish this stage. You have to do that research yourself. I can't make a recommendation. I don't know your situation. I'm not a registered advisor, so on and so forth. You have to do this. So the net current asset value, I mentioned this before, it is a floor. This is the amount that would be left over to pay out to shareholders if the company took all of its cash and paid off all of its liabilities. And then that would be what is left over. So that is the floor. And that doesn't really apply here because your price is way above that. So we know that that doesn't really matter. Graham number formula. This is another way of looking at those defensive investor requirements. People over time have used this to put a number to those requirements. And here the Graham number is 85.65, which is just barely above the current price of 84.66. And so technically it is trading below that Graham number. PEMG, as we've talked about, is 17.17. The current ratio is 1.51. PB ratio is 1.94. Dividend yield is 1.9%. And it has had 37 consecutive years of dividend growth. So you can count on that dividend growing further. Stage 4 is to look at the chart and determine when a good entry point is. And of course, you don't want to ever use a chart to determine value. That's not what charts are for. They can be useful for trying to maximize your profit by getting a good entry point, because you can see where the market is going. And you can see right now, looking at the daily view, it's been on a downward trend the last month or so. And you can see that in the chart. We've been coming down some more. This is a Harami candle. And you can see it might have indicated that we might see a reversal, but we haven't quite yet. And as of today, so far, there is a doji candle, which would indicate indecision in the market. And then you'd want to look at further candles to see which way the market is turning. Down here, we have the relative strength index. This shows momentum. You can see the momentum has been going down. It got to an oversold point on January 5th, and then it started to go back up a little bit. And it is continuing to go down right now. But it is in the point where it could start to turn back up. The price could start to turn back up. So I'd be watching this pretty closely and really watching around here. You could go back farther to find support and resistance levels. We're actually around a significant point here. This black line is the 200-day exponential moving average. And it is kind of trying to break back above that. But more significantly, this shorter term exponential moving average, the red one, is getting close to crossing over there. If it crosses over that, it could continue on a downward trend. But if it bounces back up, we could start to see the company or the price to start to come back up. So those are things to look for. If you've enjoyed this, be sure to click on the video on the screen now. It will be another one that you will enjoy. And thanks for watching, and I will catch you next time. Take care.